Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Edge Group. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Maradi, who looks after the investment side of things, particularly the direct shares investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today.
Dan, you spoke a little bit there about valuation. Now, obviously, one of the things that goes into valuations is a market, what we call a market risk premium. Many years ago, it'd be nothing to see that sitting around 10%. I think recently some fund managers have been using 5%, which obviously dramatically changes what a company's valued at. And you've seen that with the likes of companies like Tesla and things like that are valued at more than some of the bigger, more stable car companies, just as an example. So can you talk to us a little bit about, I guess, what sort of market risk premium you're seeing, especially given that interest rates are rising now?
Yeah, sure. Look, in terms of I guess from a valuation perspective, there's three components that feeds into the valuation for equities. It's your risk-free rate, which is historically the 10-year bond yields have been used as a proxy. You've got your equity risk premium, which is generally around 5 or 6%, which is that's the long-term average. Obviously, that's the figure. It changes over time from the spot, but that's the sort of that's where you get your risk-free rate plus your equity risk premium is equivalent to your equity market returns, and the third component is the beta for that stock, which is the risk versus the market. Now, from our perspective, look, the equity risk premium tends to be pretty stable, so we use that 5 or 6% level. We have used it, kept it constant throughout the period. What has changed is the risk-free rate that really is impacting the discount rates that's used to value equities. As I said, historically it used to be 5% as a proxy for the long-term bond yield, and 5% plus your equity risk premium 5 or 6%, and you get your 10 or 11% equity market returns. But what's happened over the last decade is that risk-free rate has been artificially lowered by central banks. So we've been stuck at very close to zero for a long time. So that means we can't use zero as a risk-free rate. So that number has been gradually trending lower. So what we do is basically we've got some models that take into account a combination of time-weighted historical rates across the yield curve to come up with a spot risk-free rate that feeds into our equity valuation models, and that has trended from around 5% to around 3% at the moment. So that sort of it does take into account what's happened recently, And it's been a positive tailwind for equity valuations overall. So net, if that risk-free rate is increasing, which is what we're seeing at the moment, then that is a headwind for equity valuations. And this is what we're seeing in some parts of the market. And it tends to hurt those duration equities a bit more than your lower growth businesses. But at the same time, the inputs into these factors are the long-term inflation expectations and growth expectations from overall market perspective that determine the long-term interest rates. So if we're upgrading our risk-free rates, and because of inflation and what's happening with reserve banks, the interest rates are going up because growth is coming back. So what that means, we have to also review our long-term growth rates and our terminal growth rates, which is the other side of the equation. So if the inflation is higher and growth is coming back to the market, that's why interest rates are going up. So that terminal growth rates need to be upgraded as well. So that sort of negates or neutralizes that negative impact to some extent in terms of a higher risk-free rate in valuation models. But I dare to say I don't think too many in the market are right now using rates too far above 3.5%. I don't think we're heading back to the days of 5%, because that is once again a material difference to what's in the consensus expectations, and that would imply that our interest rates are going back to those levels from the 0% we are in now, which is it's highly unlikely according to the facts that we're seeing at the moment.